Silver trades at $76 per ounce on global exchanges, but in China's physical markets, it's commanding $80, a 10% premium that arbitrage should erase overnight. Yet it persists, widening. Funds like UBS's silver vehicle are oversubscribed, with investors paying 60% above net asset value, effectively $160 for every $100 of metal. This isn't efficiency, it's fracture. Paper contracts outnumber physical ounces by over 100 to 1, a leverage that banks built to control volatility. But now, it's unraveling as demand for actual bars surges, exposing vaults that can't deliver. The system designed to suppress spikes has instead amplified a shortage, rules bending in the dark as premiums detach from spot. This break is live, feeding into supply chains where industries halt without silver. The anomaly hits hardest in the gap. Global spot holds at $76, but domestic Chinese buyers face empty shelves, forcing that 10% uplift. It's not speculation alone, it's systemic failure. Banks and exchanges engineered this fractional reserve to dampen runs, a kill switch meant to flood markets with paper promises and cap physical pulls. They activated it subtly. Overnight rule tweaks in margin requirements and delivery protocols to deter mass redemptions. But it backfired spectacularly. Instead of stabilizing, it triggered a rush. Institutions and retail alike, sensing the bluff, demand delivery, stripping vaults bare. Silver's evolution from monetary relic to critical input, semiconductors, solar, defense, means this isn't just a metal play. It's a choke point. Mining output lags demand by sectors competing viciously. Production flat while needs explode. The kill switch, that paper multiplier, was supposed to absorb shocks, but with ratios at 100 to 1, it only delayed the inevitable exposure. Look back to 2008. Then, paper gold and silver held at 50 to 1, and the system bent but didn't break because demand was financial, not industrial. Banks reset overnight, injecting liquidity via new contracts. Rules changed in emergency sessions to expand leverage. It worked. Prices stabilized, faith restored. Now, that mechanic fails because the pull is physical, strategic. China's state enterprises aren't hedging, they're hoarding for dominance. Rare earths at 70 to 90% control, now extending to silver, copper, lithium. The discrepancy screams. Why does a 10% premium endure when logistics could equalize it? Because metal isn't moving. It's locked in strategic reserves, dwarfing Western stockpiles. This isn't growth, it's severance. The logic breaks here. In a stable system, price signals coordinate supply. But when one player stockpiles beyond market needs, signals distort, creating artificial scarcity that cascades. If you track commodity flows or work in supply chains, how does this premium gap manifest in your corner? Does it signal hoarding or something else? Share your read in the comments. It could clarify where the distortion peaks. Interlace this with geopolitics. Tariffs slashed US-China trade. Fewer dollars inflowing to Beijing. Response? Accelerate conversion of trillion-dollar reserves into metals. Not panic, precision. Dollars weaken 8% this year against majors, on track for worst since 2017. Structural, not cyclical. Options traders bet bearish. Cycles like this last 5+ years. Banks' kill switch on silver aim to preserve dollar hegemony by keeping commodities cheap in paper terms. But physical exodus undermines it. China's not just buying silver, it's the entire table. Palladium for fuel cells, platinum for refining, nickel for batteries. Each ton pulled reduces dollar demand, erodes reserve status. History mirrors. Post-World War II. US stockpiled for Cold War edge, but openly, with alliances. China does it quietly, via African mines, South American bids, outpacing West, where the system loses grip. Western focus on quarterly earnings misses this decade-long accrual, now manifesting in premiums that defy arbitrage. Silver's 150% gain since early 2025 isn't euphoria, it's alarm. Investors pay 60% over NAV because physical access evaporates. Funds can't source metal fast enough. This mania layer masks the core. Genuine shortage from industrial lock-in. Semiconductors grind without silver. Solar scales halt. Banks tried the switch. Overnight hikes in futures margins to cool speculation. But it pushed more to physical, widening the rift. Compared to 1970s oil shocks, embargoes changed rules mid-game, but physical flow dictated terms. Here, no embargo, yet effective one via stockpiling. The unsaid. Media silence on these premiums as if normal. Regulators mute. That's the signal. Control slipping where oversight should clamp. Broader. Cobalt, lithium follow suit, China at 80% processing. The weave tightens. Military apps need these, aerospace too. Loss of control here means dependency, not just economic, strategic vulnerability. For those in finance or metals trading, that 100-to-1 paper ratio, does it feel sustainable, or is it the fracture point? Drop your interpretation in the comments. Differing views might expose overlooked mechanics. Now invert. Causes buried in consequences. Dollar's structural slide feeds the horde. Why hold weakening paper when metals hold utility? Beijing's genius. Convert reserves into leverage without shots fired. Western distraction. Elections, wars, allows it. Japan amplifies. Yen collapse despite rate hikes. Debt at 250% GDP. To defend, sell US treasuries, over $1 trillion held. Unwind carry trade. Borrow yen cheap, buy US assets high yield. As rates rise, trade implodes. Outflows from US bonds, dollar pressure mounts. This converges. China's metal buys drain dollars. Japan's sales flood bonds. Feedback loop. Weaker dollar makes metals cheaper in local terms, accelerating accumulation. System stability erodes at intersections. Trade shifts to renminbi, bypassing dollar infrastructure. Historical parallel, 1980s. Japan surplus recycled into US debt, bolstering dollar. Now reverse, outflows weaken it. The break, where policy tools fail against physical pulls. Silver's premium persists because arbitrageurs can't source. Metal diverted to reserves. Banks' overnight rule changes, perhaps subtle delivery caps, meant to kill the run, but expose the bluff. Investors front-run scarcity, paying absurd markups. Beneath, fear of total inaccessibility. Industries absorb masses. Solar alone guzzles silver. Defense too. China's imports surge despite flat manufacturing. Stockpiling signal. The list expands. Rhodium, vanadium, gallium. Each a node in the chain. Geopolitics threads. Africa mining rights to China, not West. Logistics strain. Ports backlog metals, not goods. Military angle. Missile systems need rare earths, silver and guidance. Control here projects power subtly. Media tiptoe. No headlines on 60% premiums as crisis. Regulator quiet signals, complicity or paralysis. System loses at denial. Acknowledging would trigger broader runs. If you're following global reserves or have seen similar in other commodities, how do you square this silence with the data? Oversight or strategy? Weigh in below. Your observations could connect dots I haven't. Transition seamless. Dollar down cycle year one, but multipliers stack. China's hoard, Japan's unwind, trade reroute. All dollar negative. US response? Debase further for owned stockpiles, inflating supply. Competition for finite metals intensifies. Not linear. Each factor amplifies others. Wall Street silos issues. Trade one box, monetary another. But reality interconnects. Feedback. Weaker dollar cheapens imports for hoarders, spurring more buys. Historical lens. Bretton Woods collapse in 71 from gold drains. Now metals drain fiat credibility. Earlier mechanics held because physical was secondary, now primary. Breakpoint. Innovation stalls without materials. West dependent on China's processing. Scale. Billions deployed monthly, reserves dwarfing ours. The process. From silver anomaly to broad fracture, control ebbing. Silver's 10% premium isn't isolated. Copper shows similar. Lithium too. Banks' kill switch, that leverage play, worked when demand was elastic. Now, inelastic, industrial. Overnight changes in exchange rules, margin calls, position limits. Aimed to switch off the mania, but ignited physical exodus. Psychology. Fear trumps greed when scarcity bites. China's evolution, from factory to controller. They process 70 to 90% rare earths, even Western mined. Extend to silver, strategic, not speculative. Dollar implications. Every conversion erodes demand. 8% drop this year, but structural, 5-year horizon. Japan. Rate hikes force treasury sales, carry unwind adds outflow. Global shift, multipolar, renminbi trades rise. System instability at convergence, no single fix reverses. For viewers in Asia or with trade exposure, this renminbi pivot, does it accelerate the dollar drain as you see it? Share your perspective in comments, it enriches the analysis. Broader canvas, metals as power base, control materials, dictate manufacturing, innovation, economies. No treaties needed. China's patient, decades building, West reactive. Window closes, committees form while positions lock. Logistics, supply chains reroute, bottlenecks form. Military, Defense tech halts without. History. Roman silver debasement led to fall. Modern parallel in resource leverage. The logic phrase, why stockpile if not for dominance? Signals. Import spikes, mine acquisitions. Media blackout is tell. Avoids panic. Regulators inaction, perhaps overwhelmed. Process midway. Anomalies spread. Premiums normalize as new rules. Silver funds at 60% premium reveal desperation. Physical unattainable. Banks' switch failed because paper can't substitute utility. Overnight. Perhaps delivery windows narrowed, but demand overwhelmed. Consequence first. Industries ration, prices detach. Cause. Strategic hoard. Interweave. Aerospace needs platinum, but China's pull diverts. Geopolitics. Tariffs backfired, accelerating diversification. Dollar. Bearish bets mount. Japan. Yen defense sells assets. Compound. Volatility ahead. System loses at multiplicity. Factors reinforce. If you've invested in metals or seen manias before, that's 60% premium, speculation or scarcity harbinger? Tell me your take in comments. Contrast sharpen the view. Final weave. This isn't endgame, phase 2. Anomalies like silver's rift signal deeper. Control shifts eastward. Dollar faces headwinds. Hoard drains, unwind outflows, debasement needs. Wealth transfer, paper to physical. Scale staggering, yet subtle. No explosions, just accrual. History echoes. Empires fall on resource mismatches. Now, modern. Tech empires on material control. The break endures, where paper promises meet physical limits. Process ongoing, stability eroding node by node. One more for those tracking currencies or geopolitics. This multi-year dollar cycle. Structural shift or recoverable dip? Drop your reasoning below. Collective insights map the terrain better. Silver at $76 on COMEX. Yet Chinese physical counters demand $80 to $83 in spot trades that clear in Shanghai and Shenzhen vaults. The spread holds at 5 to 10%, sometimes spiking to 12% intraday, and no meaningful metal flows west to east or east to west to close it. Arbitrage desks should be printing money. They aren't. Containers sit idle. Refiners report allocation quotas shrinking week on week. This is not friction. This is a deliberate valve closing. The mechanism that kept silver obedient for decades. Paper overlay at 80 to 1, 100 to 1, sometimes 250 to 1 in peak leverage periods, has been quietly throttled from the other side. Exchanges raised initial margins on silver futures by 25 to 40% in 3 separate unscheduled adjustments between late October and mid-December 2025. Delivery notices surged 300%, above seasonal norms in November alone. Approved warehouses in New York and London report certified silver bars dropping below 180 million ounces combined, the lowest since Q1 2021, while open interest remains stubbornly elevated. The math no longer reconciles. When paper claims exceed physical by that order of magnitude, and the system simultaneously tightens access to the underlying, the only rational outcome is what we observe: physical premiums decoupling upward while paper prices are capped or rolled. Aggressively, the kill switch did not prevent the run. It accelerated the bifurcation. Trace the fracture backward. In Q3 2025, Chinese industrial consumption of silver hit record levels. Photovoltaics alone absorbed an estimated 180 to 190 million ounces, up 22% year over year, according to industry trackers. Add electronics, 5G infrastructure refurbishment, and medical antimicrobial demand, and the total industrial pull exceeds 320 million ounces annually. Global mine production hovers at 830 to 850 million ounces. Recycling adds another 180 to 200 million. On paper, the balance looks adequate. In reality, the usable surplus is being vacuumed into strategic channels before it ever reaches open tender. State-linked entities and large private refiners are bidding aggressively on forward contracts, often at prices 8 to 15% above London fix, and taking immediate physical settlement. The visible market sees only the residue. This is where earlier analogies break. The 1980 Hunt squeeze was speculative greed meeting tight supply. It collapsed when regulators raised margins and forced liquidation. The 2011 peak was monetary panic layered on industrial recovery. Both times the system retained the ability to reset leverage and flood paper supply. Today, the demand driver is not hedge funds or retail mania. It is hardwired into national industrial planning and military hardening. Semiconductors require silver paste for conductive layers. Efficiency drops measurably below certain purity thresholds. Solar cells lose output if silver grid lines thin below specification. Aerospace radar and satellite components demand silver for reliable contacts under extreme conditions. These are not postponable. A nation building out 400 gigawatts of annual solar capacity and expanding hypersonic and satellite constellations cannot negotiate with spot shortages. They preempt. If you're inside photovoltaics, semiconductor packaging, or defense supply chains in Asia, what allocation notices or purity requirements have changed in the last 6 months? Drop the detail in comments. Patterns there often surface before they hit headlines. The premium itself tells a colder story. At 60% over NAV on certain China-listed silver vehicles in November, investors were effectively bidding $125 to $130 per ounce for exposure, when global spot sat near $76. By mid-December, that premium compressed to 35 to 45%, not because supply eased, but because many funds simply stopped accepting new subscriptions. They cannot source incremental bars at any price that keeps the structure solvent. The compression is not normalization, it is rationing by refusal. Meanwhile, parallel vehicles in Hong Kong and Singapore show retail and institutional queues forming for physical kilo bars and 1,000-ounce good delivery bars, with wait times stretching to 8 to 12 weeks. This is not a bubble topping. This is a market learning. It cannot trust paper abstraction when the real input becomes strategically rationed. Zoom out, and the pattern repeats with frightening consistency across the criticals. Copper. Shanghai premium over LME persists at 800 to 1,200 yuan per ton despite record global output. Lithium carbonate. Domestic Chinese prices decoupled from spodumene benchmarks by 30 to 50% at peaks in 2025. Cobalt. Refinery bottlenecks in China keep intermediate prices 20% above international despite Congo mine expansion. Rare earth separation. Still 85 to 92% Chinese control, with export quotas tightened again in November 2025 without public explanation. Each commodity shows the same signature: physical tightness masked by paper stability until the mask slips, then localized premiums that refuse to arbitrage away. The unifying thread is conversion velocity. Beijing's dollar stockpile, still north of $3.2 trillion in official reserves plus undisclosed commercial holdings, is being redeployed at a pace unseen since the 2009 to 2012 commodities supercycle, but this time without the corresponding export boom. To replenish dollars, bilateral trade with the US remains suppressed by tariffs. Exports to Europe and ASEAN grow, but increasingly settle in RMB or local currencies. Net dollar inflows slow, while dollar outflows for resources accelerate. Every physical ton purchased is a permanent reduction in dollar demand. The effect compounds quietly. Lower reserve recycling into treasuries, lower petrodollar flow recycling, lower carry trade collateral demand. Japan's contribution to the pressure is now measurable. The yen carry unwind crossed inflection in Q4 2025. Japanese banks and life insurers reduced U.S. Treasury holdings by an estimated $180 to $220 billion since July, the fastest quarterly drawdown since 2015. Carry positions estimated at 4 to 6 trillion notional have seen 25 to 35% reduction in leverage, according to BIS derivative data. Outflows feed directly into higher U.S. yields and weaker dollar index, which in turn cheapens metals in yen and RMB terms, feeding the next round of purchases. Feedback is no longer theoretical. If you track cross-border capital flows or hold positions in yen-funded assets, how pronounced does the carry unwind feel on your desk right now? Orderly exit or forced liquidation? Your read in the comments helps calibrate whether this is still contained or already systemic. Silver is the canary because it sits at the intersection of monetary memory and industrial criticality. Its dual nature exposes the contradiction fastest. Paper markets still quote it as an inflation hedge or industrial proxy. Physical buyers treat it as insurance against supply chain sovereignty loss. When those two valuations diverge permanently, the older architecture, built on infinite paper elasticity, loses legitimacy. We are watching that legitimacy erode in real time, not with fireworks, with widening spreads, lengthening delivery queues, shrinking certified stocks, and regulators who adjust rules in the middle of the night, yet cannot restore equilibrium. The process has phases. Phase 1 was recognition inside China. Paper, not equal metal. Phase 2 is institutional front-running. Pay the premium now or risk industrial paralysis later. Phase 3 is global spillover. Western fabricators and defense contractors discover they are bidding against sovereign demand with far deeper pockets. We entered Phase 3 in autumn 2025. Phase 4 arrives when Western governments are forced to respond, not with rhetoric, but with actual strategic purchases, funded by debt monetization or asset sales. That response itself weakens the dollar further. closing the loop. No single actor launched the kill switch failure. It emerged from misaligned incentives. Western exchanges protecting their clearing members' leverage, Chinese industry protecting production continuity, global investors protecting purchasing power. The system was never designed for simultaneous sovereign hoarding and industrial inelasticity at this scale. When those forces collide, the weakest link, paper abstraction, snaps first. One last question for those who've watched previous resource squeezes. Oil, 1973, rare earths, 2010, nickel, 2022. Does this silver bifurcation feel more like a contained regional stress or the leading edge of a broader critical's reprice? Your historical comparator in the comments would ground the scale. The fracture widens methodically. Stability was always conditional on belief that physical access would remain frictionless. That belief is gone. What replaces it is not chaos, but a new sorting. Those who hold bars dictate terms to those who hold promises. The resorting is underway. The global spot. Silver benchmark hovers at $76.92 per ounce as of December 26, 2025, after touching an all-time high of $75.62 earlier in the session, before extending the breach to $76. Yet, on the Shanghai Gold Exchange, physical delivery trades cleared at equivalents pushing $78.49 to $78.55 per ounce just days prior, with premiums exploding to over $8 per ounce above COMEX futures. Backwardation has set in. Near-term contracts trade below longer-dated ones, signaling acute immediate scarcity in the world's largest consumer market. This is not volatility smoothing out. This is the physical layer detaching from the paper layer in plain view, and the detachment is widening on the final trading days of the year. The kill switch, those margin hikes and delivery protocol tweaks, has been pulled multiple times in 2025. COMEX raised performance bonds on silver futures by roughly 10% effective mid-December, following earlier adjustments in September and October on both COMEX and Shanghai exchanges. Each increase was framed as volatility control. Each time, it failed to contain the physical pull. Delivery notices remain elevated. Certified warehouse stocks in New York and London have thinned to levels not seen since early 2021, and open interest clings high despite forced deleveraging. The system that once absorbed speculative excess now chokes on industrial inelasticity. When you tighten access to the underlying, while demand for actual bars surges from photovoltaics, projected to absorb 180 to 190 million ounces in China alone this year, electronics, and defense hardening, the result is predictable. Premiums that refuse to collapse because metal simply isn't available to arbitrage away the gap. China's domestic stockpiles on exchanges hit decade lows by November, exacerbated by record exports earlier in the year, over 660 tons in October alone, before authorities shifted gears. Export restrictions, phased in via licensing requirements and effective tighter controls from January 1, 2026, target bullion outflows. The stated rationale: protect domestic industrial continuity amid solar capacity additions exceeding 500 gigawatts globally. China dominates the chain. Semiconductor expansion and strategic reserves buildup. The effect is immediate. Internal tightness intensifies. Shanghai premiums spike. Backwardation deepens, and global physical flows reroute or stall. This isn't conservation in response to shortage. This is preemptive rationing by the single largest absorber of silver, now choosing to retain rather than recycle dollars into exports. The global deficit, already structural at 200 to 250 million ounces annually, faces an effective amplification as one major supplier clamps the valve. If you're in solar supply chains, refinery operations, or Asian metals trading, how has the backwardation and export licensing shift altered your forward booking or allocation this month? Your on-the-ground read in the comments could pinpoint whether this is still localized stress or the start of broader rationing waves. The premium structure tells the colder calculus. An $8 plus Shanghai premium over COMEX isn't transient basis noise. It means industrial users and state-linked buyers are willing to pay 10 to 12% more for immediate delivery in China than the paper market quotes globally. Arbitrage should flood metal eastward until parity returns. It doesn't. Containers aren't moving at scale because exporters face new scrutiny, quotas, or outright discouragement. Vault drawdowns in Shanghai accelerate, while Western warehouses see only modest inflows, much of it already committed or held under long-term contracts. The old mechanism, flood paper to cap prices, let physical settle later, breaks when the physical is sovereign priority and inelastic. Silver's designation as a U.S. critical mineral in recent years only underscores the irony. Western policy recognizes the strategic value, yet response remains committee stage while the metal flows into Eastern reserves. Parallel fractures appear in adjacent criticals. Copper maintains persistent Shanghai premiums of 800 to 1200 yuan per ton. Lithium and cobalt show similar domestic decoupling. Rare earth separation quotas tightened again in late 2025 without fanfare. Each instance shares the signature: physical constrained, paper stable until it isn't. Premiums that endure because normal market clearing fails against strategic pull. China's role as processor, 70 to 90% of rare earths, dominant in refining chains, extends here. Silver mined elsewhere often routes through Chinese facilities before re-export or domestic use. When that choke point prioritizes internal needs, the global chain feels it downstream. Dollar dynamics compound the pressure. The index weakened further into year-end, amplifying metal's appeal in local currencies. Japan's treasury holdings, down to around $1.06 trillion from peaks above $1.08 trillion earlier in 2025, reflect ongoing yen defense sales, estimated $180 to $220 billion reduction since mid-year. Carry trade unwind continues, with leverage compression in yen-funded positions feeding outflows from U.S. assets. These aren't isolated. China's dollar-to-metal conversion, reserves still massive but inflows slowed by trade suppression, reduces treasury demand. Japan's sales add supply. The feedback is multiplicative. Weaker dollar cheapens imports for hoarders, accelerating accumulation. Higher yields from outflows pressure U.S. financing costs. Debasement to fund Western catch-up stockpiling only erodes confidence further. If you've monitored Treasury TIC flows or yen basis trades in recent weeks, does the pace of Japanese reduction feel contained to currency defense? Or is it bleeding into broader reserve reallocation? Your observation below would help gauge whether this outflow remains orderly or is tipping toward acceleration. Silver exposes the contradiction fastest because of its dual monetary industrial identity and smaller market size. Paper still trades as proxy for inflation or hedge. Physical trades as input sovereignty. The $76 to $78 spread isn't inefficiency. It's evidence the abstraction no longer commands the real. Phase 3. Spillover is here. Western fabricators bidding against sovereign depth discover queues lengthening, premiums embedding, and forward curves inverting. Phase 4 looms when governments move from reports to actual purchases, funded by issuance that further weakens the currency they defend. No central actor flipped a master switch to break the system. It fractured under misaligned time horizons. Exchanges protect clearing stability quarter to quarter. Industry secures continuity decade to decade. States secure leverage generation to generation. When those horizons collide at finite supply, the paper superstructure, built for elasticity, loses credibility first. What follows isn't disorder, it's reordering. Those with bars set terms, those with promises negotiate access. For those who've tracked commodity squeezes across cycles, Hunt 1980, Rare Earths 2010, Nickel 2022, does this Silver-China dynamic feel like a contained regional dislocation, or the precursor to multipolar repricing across criticals? Your comparator in the comments grounds the magnitude. The process is no longer emergent, it is entrenched. Premiums that persist into year-end, backwardation that holds, export valves tightening ahead of January. These are not symptoms resolving. They are the new baseline from which the next phase departs. Stability, once conditional on frictionless access, now rests on rationed allocation. The resorting continues, bar by bar, vault by vault.